Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. Joining me today is David Smith. He's a senior analyst for the Morgan Report, a regular contributor to Money Metals Exchange, and an ambassador to Lode Cryptographic Silver Project. How are you today, David?
Very good, Tom. How are you?
Excellent. In doing research for this discussion today, I really like the kind of philosophical approach that you take. And one of the quotes that struck me that you use to approach this market and you're thinking about it is Mizu no Kokoro. So can you tell us what that is and how it informs you entering into this battlefield, as you called it?
That's a Japanese phrase that's translated as mind like water. And there's another variation of it, Tsuki no Koko, which is mind like the moon. And I interpret that as being a situation where an investor or trader has a very calm demeanor and understanding as they step onto the battlefield marketplace, which it really is, because you're doing battle with all sorts of other investors and information flows and things. And the idea is that you've done your research, you've decided what you want to do, your approach. In the case of the precious metals sector, as David Morgan always recommends, you bought some physical metal and put that away as insurance first, profit second. And then you've decided to accept a little more risk, and so you get involved in investing in mining stocks. And you research them, you get a good service to give you suggestions, and you go and do that, and you set up a plan that accords to you psychologically, financially, how much risk you can take, that type of a thing. And then you go out there, and you're pretty calm, and kind of almost Zen-like. And like that water where I have a picture where the surface of the water reflects the sky and the clouds just as they are and the boats and everything else. And it's almost like a double reflection. And if you can do that, you're going to be so far ahead of other investors because they're out there. It's like a massive chaotic mob type of a scene, especially during an impulse leg in the metals like we saw the last few months, or like what we saw in March when the mining stocks collapsed down to lows people couldn't believe, but then 6 weeks later, they were back up to where they were. And so a person that could have acted calmly on that and bought some of the 2 or 3 best choices would have had a 5X by the time this thing went back to where it was. And so this is the type of thing that I think is really important to try to build for all of us. And I have a kind of an adjunct to that I call psychological capital. And I think it's important as the money in your account. If you get caught up in the in and out trading, in the chop, let's say, of a sideways congestion like we have now, where you're trying to catch every 5-cent move and then it goes against you and you get out, or when it takes off and you didn't buy before, you didn't buy anything into a decline, you're supposed to try to buy when others are selling and sell when others are buying. And then you try to catch up and put a big blob in the market. And of course, the very next day it turns around and drops 10%, but that didn't mean anything really in the bull run, but it knocked you out. So your psychological capital gets corroded. And if you lose that ability, you can have a multi-million-dollar trading account. But if you can't handle it psychologically and be like the mind like the water, you might as well just quit trading because you're just going to fritter away your money and your opportunity to make the big money that we all believe is underway in these mining stocks and in the physical metal prices.
Absolutely, David. And I'd like to touch on that a little bit later as part of how we're going to be able to capture the profits. But why don't we start first by talking about the 3 tailwinds for mining stock investments right now as you see it?
Well, there are several things that I think all 3 of them are historic, really, in a way, in several ways. One of the things is that depending upon what chart you use, in fact, I think one of the charts that I've used in my presentations, I did one at Money Show Canada a few weeks ago, and I did a Sprott show, a virtual here a couple months ago. One of them, I believe, is actually a Palisade chart. It shows commodity prices in relationship to stock prices at 80-year lows. You have to go clear back almost a century to find this kind of a disconnect. And what that means is that the potential for a turnaround, especially after it's been down a long time, which it has, making new lows and everything, the massive potential there. You want to buy when others are selling and sell when others are buying. And so putting together, going out and doing your research and getting a few quality companies that are producing, some juniors, a couple seniors, a few exploration plays, and putting that in will put you in a position, and then being patient will put you in a position that if our premise is right, that we're heading into what David Morgan believes is the third and last and biggest leg at the precious metals secular bull run. These prices, the nominal prices that we will probably see, will be almost unbelievable not only in the physical space, but also in some of these mining stocks that are really doing a great job, that make a new discovery, that really become profitable because they've cut their costs in relationship to rising metal prices. That's the type of thing that we're going to have an opportunity to do. Also, gold and silver companies have, for the most part, underperformed the metal. Now, they should overperform because they represent a higher degree of risk than holding the physical metal. A mining company can go to zero, but gold and silver never have in 5,000 years. So you should be expecting an extra profit reward for holding a company versus holding your hand metal. And that has not been the case for much, depending upon what chart you use, for the last 25 years, and in some cases the last 75 to 80 years. Most of that time, the stocks have underperformed. But now, looking at the charts and looking at all sorts of other evidence, there's strong indications that the miners are ready to outperform. So the time and effort and money you put into mining stocks today has the potential, if you choose the right ones, to pay you back much greater amounts than anything that you might have done over the last few decades. That's a very powerful tailwind. Also, within another tailwind is that usually the seniors and the junior producers are fairly well correlated to each other in a relationship. And if you look back to the beginning of the run in 2000, they were spread apart at the beginning, but then they stayed together. And for most of that time, through 2011 for sure, there was a correlation. But now the gap is bigger than it was in 2000. In other words, the juniors have underperformed the seniors in a more massive way than they have in the last 20 years or more. And that's starting to change. And if you get good quality juniors, and as the bigger money and funds come into those juniors, they will close that gap. And so you'll make more money on a good junior relationship-wise, percentage-wise, than you will a good senior because they've already underperformed so much in relation to their historical role. So that's the second tailwind. The third one is a bit more esoteric, and it's impossible to quantify right now. But I believe that as people find that they can't find physical or they can't afford it, and then they move into the mining stocks, and then those become explosively more high-priced, they're going to be looking, they still want the physical. With the arrival of the blockchain and Bitcoin and all the cryptocurrencies, there are a number of projects out there that are seeking to digitalize gold and silver. And some of these are just storage devices, but some of them, like the load project that I'm kind of associated with a little bit, it's really beyond that. It's attempting to create a monetary system where you can spend gold and silver. But be that as it may, it's also a storage system because just like an ETF, when somebody buys one of these digital tokens or coins that are backed by gold and silver, then the project has to go and buy that physical metal. And so you can acquire the physical metal that way when you might not be able to get it through your corner coin shop or through even a big distributor, that sells, or even a mint. But you can get it that way. And I think people will be driven to that way, which will create another demand tailwind for the metal, which I can't quantify, but I do know that I believe it is totally unexpected and unplanned for by the supply metals community.
Very interesting, David. In doing research again for this conversation, you were talking about how in 2016 we saw a false bull run. So what is the difference between that quote unquote false bull run and today?
Well, there are a couple of differences. One difference on the chart, which is very important, is that the 2016 highs have been exceeded by most of the indices and many of the mining stocks. This is very important. And so the idea of technical analysis that old resistance, once penetrated, becomes new support. So the 2016 highs being penetrated on the upside. Now 2016 is a support layer. It doesn't mean that prices can't drop down below that a bit, but in order to provide the integrity of the bull run, which we have right now, you want to see those horizontal support lines pretty much hold without being penetrated too deeply. And what's going on right now is a testing of those general areas, sometimes well above the 2016. There's dipping down into it. And so that's a very, very important actual visual technical factor. But beyond that, the 2016 was very powerful. I mean, it was breathtaking, really, for those of us who participated in it. And most people didn't stay on for most of it. They kept looking for these resistance levels to stop prices. They didn't. And something similar happened between $20 and $26, $27 silver a few months ago. People thought that when silver got above $18.50, it would spend months chewing its way up to $22. It went through that like a knife through butter. And so what I'm suggesting is that the people, they missed a lot of the bull market and the 7-month market in 2016 by getting in and out when they were afraid of resistance, slowing things down or turning them around. Now, this is the real deal. And if you go, oh, $30 silver is going to hold for 10 months, well, maybe it will. But what happens if $30 silver is penetrated, perhaps before the end of the year? And E.B. Tucker talks about this, and I believe he's got a good chance of being right. He thinks we'll see $40 silver by the end of the year and $2,500 gold, at least an attempt to hit that. But what if you think 30 is going to stop things, and then you sell out, and it goes to 36? Are you going to get back in? Probably not. And if you do, it'll be with a smaller position. So this demands, I think this last part of the run that could go X number of years demands a fundamentally different approach than the idea that you could buy and sell constantly and capture anything like the majority of the move that's going to be presented to you. I think this is an important thing to keep in mind. Also, in 2016, when that failed, it dropped for 2 years, and a lot of those gains were given back. And I remember it was very depressing. It took 2 years, and I know people that I've heard about, and a few that I knew personally, that have held physical gold and silver for decades, and they sold out. They couldn't take it anymore. And a lot more of them, when they got up to the 2016 highs that we're now discussing, they sold out too because they couldn't believe it was going to happen, and they're sitting now with very little or none. And I think that's going to be a huge mistake for people that have held on so long. They know too much. The millennials don't know as much. They don't know enough to sell at the 2016 highs because they didn't experience it. And they're the ones, some of them, that are going to profit mightily from this massive bull run that we see coming right on the horizon.
So, David, that brings me perfectly into the next point of the book that you and David Morgan wrote called The Second Chance. So can you give us some ideas on basically building that framework on how to capture some of those profits and not get left behind?
Well, I don't know that we've ever seen a book. We've seen some that have talked around the edges about it, but a book that everybody talks about how to make big money in the metals, okay, and the miners. Nobody seems to discuss or give much thought to how to hang on to most of it. And the sad fact is that the majority of the people that run up these huge accounts, and we've heard of them, or maybe we know some people that, took 100,000 and went to 20 million, or they took 10,000 and went to 250,000. They seem to run it all the way back down again, and it's like a yo-yo. It's kind of exciting when you're doing it, but when you stand back and look at it, it's kind of depressing. And so we think that we have an approach that makes sense from the standpoint of human nature and makes sense from the standpoint of the way these markets run, because they eventually are all going to be over. And so the idea is to go in and get your positions and do your research and balance them out and whatnot. And when you start making that big money, start asking yourself, how do I get out of most of it? How do I get out of this? Because someday it'll be over. We don't know. It could be faster. David Morgan thinks it could be faster than we expect. It might only be a couple of years before these highs are hit. But it could go out 5 or 10 years. We just don't know. But you get to the point where you've captured really large projects, you want to start taking some of those out of the market. And finally, at some point, you want to get to the point where you don't want to make what I call the palladium, I call it a disease or whatever, but it's a big mistake, where palladium 20 years ago, almost 25 now, it established a high of about $1,100. And I'll never forget, Ford Motor had bought all sorts of palladium. They sold their palladium for $1 billion loss a few months later. That was the high for many years. 20 years later, 23, 24 now, it hit 1,100 again. And I was participating in some of those mining stocks. And I looked at that old chart and I thought, boy, a 20-year high, this is going to be it. And I watched how it had made an island reversal, 20 years ago. And so I sold my mining stocks in that sector, and it went down to 950, and I just thought I was a hero. And then it went back up again, and then it's poking around 1150, and suddenly it's 1400. And I watched it all the way up to 2800. I watched it. And it didn't just go up there and have a 2 days at that price and then drop. It's still up there. Years later, it's still trading between 2000 and 2600. But just think, if you had not sold everything, but if you'd made plans to have a certain amount of your holdings to keep on in case you were wrong by 300%. And that's what's going to happen to people in gold and silver. None of us is going to know for sure what the highs are until they happen. So let's say silver goes to $100 or $125. And we have a lot of evidence that that's going to be the high, or it is. And so we get out and we're heroes and we made a lot of money, and it goes down to 90, and then it goes to 250. How are you going to feel? And so our book enables you to have a way to do that. We call the sacrifice throw portfolio. And it's explained very clearly in the book. We devote a couple chapters to it, and how you can prepare yourself to keep most of the money out of the market if you were right, and you put some of your holdings that you decided beforehand into this portfolio and leave it alone. Be willing to risk it. If you're wrong, you lose all of it. If you're right, you might make another 5x. But meanwhile, you won't get back everything you ever earned during the whole bull market, which a lot of people are going to do. And we think that this offers people a real alternative that they've never had before or thought about before, to being able to cheat Mr. Market, because Mr. Market doesn't care about you. But if you don't understand his rules, it's just like what they say about Alaska. I used to live up there. Alaska environment isn't against you. It's just that if you don't know the rules, you're going to pay the price. And that's what's going to happen in the market. We also talk about how people behave during the Klondike gold rush. And the mentality of people in the gold rush has never changed, Tom. It's the same way today. It will be the same way today as it was by the people that went up to the Klondike. And I've been up there to see where these gold rush places were. And they went up there to find the gold. And most of them didn't keep it. And some of them didn't even really work for it properly when they got there. But I mean, a little planning beforehand would have meant that they could have, some of those people made enough money to live easily the rest of their lives. But most of them either frittered it away or put it in bad business decisions that weren't well thought out. But they never had a plan. You can have a plan to make a lot of money, to keep most of it, and then go on and make it work for you, because it's more than making money. It's about what you do with it and how you help others. And I love Doug Case's comment that he's made at a conference. He said, there are no luggage racks on a hearse. And that's really important. It isn't just that you make money. It's what do you do with it, and how does it transform you to make you a better person so that you can help others and you can become elevated yourself by that money and by what can be done with it, rather than let you become a slave to it.
I couldn't agree more, David. But as we're talking about this meteoric price rise, and let's take silver for an example, we're mining it at a ratio of only 8-to-1 to gold, but it's trading at closer to 80-to-1. And you speak about between $26 and $49, we'll get what you're calling a volcanic tremor, and above 50, we'll get a pyroclastic eruption.
Right. It'll be like Mount St. Helens going off. They'll cover the horizon and it'll cover the whole states with dust. I mean, it'll be like that emotional fallout where people aren't going to be able to believe it. And that will institute the panic gold rush mentality into the mining stocks, into the physical, into the digital backed gold and silver coins. And it'll be a mania. And here's the thing, Tom, this is important. People need to understand, and David Morgan and I participated in this. We didn't know each other then, but we participated in that bull market that hit $50 silver in 1980 and $850 gold for only 2 days in 1980. That was a limited market. That was a very tiny percentage of the North American investment population. There were no massive debts. All these things that we've got going on now, the social disruption, none of that was going on. There were a couple of Arabs that were involved, and there were a few people in Europe. There was nothing going on in India or China or all that. Well, right now, all of the countries of the world have similar problems of debt and all that, and they also are investing heavily in gold and silver. Last year, I think India consumed 40% of the silver production of the world. So this is going to be a massive dislocation, these what I call these tectonic plates rubbing against each other. One tectonic plate, the one on the top, is the supply, and the one going under the subduction zone, going under it and thrusting it up and breaking the crust, that's the demand. And the demand has the ability to put massive pressure on the supply and break the supply pipelines and break the ability of miners to ramp up their product and get it out there to meet the demand. And that disruption, as long as that disconnection is underway, you're going to have a continuation of that bull market until some semblance of a balance years later gets taken care of. And the irony is, too, is that if the prices do stay elevated, in other words, if they don't just crash, let's say they go to 250 silver and they crash to 125 and stay there for 5 years, think of the profit that these companies are going to be making years later. And that's what happened in the 1980 bull market. For 8 to 10 years, some of these gold companies were throwing off profits you couldn't believe, even though gold was down $400 from the high.
Yeah, it's pretty crazy to think about in those terms, as you say, David. But something you mentioned a little bit ago is about owning physical. So how should one approach their thinking about paying the premiums on physical right now? Obviously, since March, we've seen premiums really, really rise. So how do you approach that in this new environment?
Well, first of all, hopefully our listeners have some, but I know that realistically some of your listeners have none. And so they're going, oh my gosh, I have to pay $5 or $6 or $7 premium for silver where I could have got it for $1.20 6 months ago. Well, yes, if you're going to do it, you have to. That was then and this is now. Maybe you can find a better price, buy it in tranches, buy a little bit every month, how you want to do it, but get some from the insurance standpoint, get some of that physical, the same with gold. And I understand our Canadian listeners are at a disadvantage because they're buying U.S. dollar prices at Canadian dollar prices. They get 75 cents. They don't have a dollar or $1.10 like they had a few years ago in terms of exchange. But the point is, first of all, it's such an asymmetric trade. You don't want to be buying commemorative coins or designer bars. Just forget that. Or these collector coins. Stick with the physical. Get the 1 ounce trade rounds, or the American Silver Eagles, or the Canadian Maple Leaf Silvers, or Krugerrand Silver 1 ounce, and get your American Gold Eagle, and get your Canadian Gold Maple Leaf, which I think is maybe the most profound coin out there because of the design and the fact that it's 4 nines, and they've got all sorts of things on it, that lasers and everything that makes it can't be counterfeited. But get some of those, and if you can't afford the full ounces, get the quarter ounces or the half ounces. And put a little bit of that away in a safe place where you have control over it. Don't commingle it with other accounts. Don't put it in some place that you don't know if they've even got it. And that's your insurance. And that's liquidity. Nothing else has the liquidity of gold and silver physical if you really need it right now. Then go into the mining share area, do your research. Somebody said the other day, I can't remember who it was, he said, there's 1,000 mining companies, Canadian mining companies now. I wouldn't touch 900 of them or 850. And that's really true. Most of them, there are names coming out we've never heard of before. Now, if it's backed by somebody with a name like Eric Sprott or Quentin Henney or somebody like that, I'll take a look. But if it's somebody I've never heard of, or it's been there for 25 years and they've never produced anything or sold to a major, I'm probably not interested. So really do your due diligence. And the good news, Tom, about this, I believe, because I was around in the 2011 when we had this drop off in 2008, a lot of the junk companies have gone to pot. Literally, they're trying to sell pot plays, or they're trying to do something else. They've reinvented themselves. They're like a locust that comes out of the ground every 17 years, and they look a little different each time. Just skip those things. Stick with the good names, the ones that have proven that they've done it time after time. Projects that maybe that Ross Beatty's working on as an example. He's known in the business as the broken slot machine. 13 of the 14 companies he brought into existence paid shareholders very, very well. Nobody's perfect. With an odd like that, would you rather invest something that was backed by a person that 13 out of the 14 times was successful, or somebody you never heard of that's got a bright idea that maybe 1 out of 3,000 odds chance will turn into something? Those are much different odds if you ask me.
I couldn't agree more, David. And one of the things that I like, kind of the way you frame it, is when we see demand really start to push prices higher, like demand is obviously rising with the price, but you're also comparing it to when the price starts to fall, demand is staying the same at this time, correct?
Right. And this is another thing which is fascinating, and I haven't seen much talk about this, and it's not 100% correlation, but it's darn close. Nowadays, when the prices rise, people keep buying. And when the prices fall, people keep buying. And that wasn't the case before. Usually you expect a big drop off in demand when the price goes up or the premium goes up. People are coming to the realization that if they don't pick up something now, almost regardless of the price, they're not going to get anything. And the day is getting late. The door is starting to close. And then at some point, if you have waited long enough and you weren't willing to pay that extra dollar, an ounce premium, you are going to become a spectator. You're going to watch what's going on rather than a speculator which buys in hopes of higher prices. And this is an asymmetric trade. You don't have to mortgage the house. You take a certain amount that you're comfortable with, you buy your metal, you put it away. You do the same thing with the mining stocks that you buy, figure out what your risk reward is and all this kind of thing. And you can do very well because you're not risking $1 to make $1. You're risking $1 to make $5 or $10 in the physical. You're risking $1 in a mining stock that you've chosen well to make I think a good one will make an expectation should be 7 or 8 times your money over the course of this cycle, that you'll have access to that kind of a profit. If you hit a new discovery or you hit one that's turned around things and become much, much more efficient, you should expect 10, 20, maybe even 30 times your money. And if you hit something like what happens a couple or 3 times in a cycle, and I think because one of the big drivers of this last part of the cycle will be discoveries, big new discoveries. I think that there's a potential for a couple or 3 or 4 of these discoveries to return 30, 40, 50, maybe even 100 times your money. And you don't need to put a lot in to make a big strike at that. You just salt it around, and Morgan always recommends in our speculator section, don't pick one that you really like. Pick all the ones that we have and put equal amount of small money into each one. And people, the greats, Rick Rule, Eric Sprott, all these people, they do that same way. They put a little bit in the bunch. And you look at Eric, he puts a little bit in the bunch, and when something starts outperforming, he'll put more into it. And that's what you do too. If you find one that is really looking good, then you can double down, but don't double down before you know what's going on. And also something too about trying to figure out a company, even if it's got a big name attached to it, before they've hit a good drill hole. We talk about an individual that made the biggest amount of money he ever made as a broker was on the Fruta del Norte that Keith Barron discovered in 2006. That was the biggest gold discovery of the last 25 years. That was in Ecuador. And they did not get in until after the first couple of drill holes proved that they were onto something potentially very big. You could have bought that stock at 60 cents, not knowing anything, and it might have gone to zero. But they were bought it at like $2.50, but yet it went to $40. They caught most of that because they waited until there was demonstrative evidence. Yes, there's something here, and it's looking better all the time. They followed the drill holes, and they bought more as it went up. And so that's a different mindset than the people that just try to get it out there before anybody figures it out. And most of the time, it turns out to be a dry hole.
So there's an interesting parallel here as well, David, when we're looking at the demand with prices rising and then prices falling and demand staying there with ore grades. So you were talking about ore grades correlating with the margins. So as ore grades are falling, margins are also falling. And an interesting thing that you also brought up to me was that reserves are falling. So explain to us a little bit more about that, please.
Well, if you look at gold, silver, and copper, all 3 of these metals share a very similar situation. They're different in many other ways. But the grades, if you look at the chart of all those 3 metals, you will see it for the last anywhere from 10 to 20 years, almost every year, the amount of ore, the amount of metal that they get per ton of ore dug out of the ground has been decreasing. So silver is down like 54% over the last 10, 12 years, 15 years. And this is true of all the primary silver producers. It's true of Fresnillo, the big monster in Mexico. The chart shows it. So they're digging out twice as much ore out of the ground to get the same or almost the same amount of silver that they did before. So this is a significant problem. Part of it has to do with a lot of these mines are late in life of the mine, and every mine runs out of ore at some point. And they're also true because there haven't been major discoveries. That's another thing. But I mean, just a few days ago, Barrick Gold, the world's largest gold producer, came out with the CEO said, "Hey, we're facing a crisis in reserves." Now, reserves, for people who don't know all the categories, but reserves are the highest of the 5 NI 43101 categories that indicate that the probability of economic retrieval from the ground. So you have reserves proven and probable. You have resources measured, indicated, and implied. And so reserves are at the top. That says we can almost certainly mine this at a profit, especially if prices are going up a little bit. And so every ounce of gold that Barrick or any other company mines, that's one less ounce they have in the ground to sell. They are a wasting asset unless they can increase those reserves to the point that they are replacing what they're mining. And this is becoming a big, big problem for the seniors and a fair problem for the juniors as well. And the explorers are trying to pick up the difference, and they're going to get taken out, the ones that are more productive or prospective, so that the seniors can replace those reserves. And as we go forward, that's going to become more and more common. And these companies, whether they're a producer, junior, or whether an exploration company, they tend to get taken out at anywhere from 45 to sometimes 150% of the previous day's close once an announcement is made like this. So that's another way, if you have a quality company, you can get taken out and you can get a beneficial bump in what you get and then you can go on and try something else. But that M&A, mergers and acquisitions, that's going to become a much, much more common feature of our daily life in the investment space going forward.
So, David, when we're thinking about investing in, let's just consider silver miners for right now, what are the considerations that you would give to investing in individual miners versus something like SILJ?
Well, SILJ is fine, or any of these ETFs, but they have a certain percentage that they can hold. And if you have a wildly successful miner in that index, they've got to rebalance that. They got to sell a bunch of that stock to get it out. So you can actually be hurt. Your performance of the ETF gets hurt, even if you had a good stock that's really in there. So if you can find a company, ideally one that maybe isn't even in the indices, that does very well, and there are less than 24 primary silver producers, I think, in the world that, where more than half of their profits and ounces mined come from silver rather than silver equivalent ounces. You'll see that all the time. Oh, we did 1 million silver equivalent ounces last quarter. Well, look at that. Maybe that's 50%, lead and 40% zinc and 30% silver. You got to ask yourself, silver equivalent ounces is different. And I won't mention the name because they're very profitable, but one of the best primary silver producers out there, it's not on this continent, up to 40% of their income from a quarter comes from lead. They produce a lot of silver, but they are by no means a pure silver play. There's a tiny one in Mexico that I visited twice and I've written about, and I think 95 to 97% of their ore ounces and their profit come from silver. And so for me, I want that kind of a play. And there's another company that we all know about they have 3 mines now. They had 7. They got rid of their silver equivalent ounces mines, and they've done all sorts of things. Right now, they're a little under pressure because of the tax issue in Mexico. But that company is stronger internally, I think, than it's ever been since I started following it, 15, 20 years ago. And they're becoming more of a pure silver play. So if you're really a silver bull and you think that thing is really going to go, you want to find the best of the best producers in that space, and you would much rather have a company that's 60 or 70% silver production rather than one that is, silver equivalent ounces and turns out 30% is the silver. It's just a way to maximize, lead and zinc, you make money on that for sure, but if you're after silver, that's what you want to try to find.
So, David, as we're talking about having pure silver ounces, not silver equivalent ounces, what are some of the other considerations that you try and find when looking at some of these companies that you want to put money into?
Well, I look at the management, what's their cash burn rate? How have they been helping shareholders over the years? How did they handle the 2011 to 2016 and then 2016 to 2019 downturn? Are they finding new discoveries in brownfield, which is basically the project area that they're already in as opposed to something brand new? And that's a good productive way to increase your reserves, is to find more right under your feet. And sometimes it's literally that way. But I want to do that way. I want to look at them, did they get the message out? And they don't have to be overly promotional. Some of these companies don't do a whole lot in that regard, but are they highly regarded in the industry? Are they respected by their fellow colleagues? Do they treat their shareholders well? Do they not overcompensate themselves? There are some of these companies that are lifestyle companies. They don't do very much except, private placement every so often so that they can afford more big trips, and that's not what shareholders need to be focusing on. So I think we're late enough in the cycle that you can fairly easily identify the people that are what I call best of breed. And, I wrote an article, it was by invitation and I didn't get paid for it. I love doing it. I wrote an article just a few weeks ago. It's in the Prospector News September to October issue. And people can even we'll send it to them free if they want to have a breakout article of it. It's a 2-page article. It's about the 4 best of breed mining geologists that I know of. And there's a couple more. I could have made 6 or 7, but 4 is a nice number. And I chose those people because they've done it before and they keep doing it, and they don't always succeed, but over time, their successes massively outweigh their misses. And that's the kind of thing. And I told them in the article, I said, you don't want to get this article and find, what are the 5 projects they're involved in? I'll buy one of each. You want to ask yourself, how do they think? How can I think like they think? How can I find something that they haven't found yet or that they missed? They're not going to find everything. And if you start thinking like they think, I guarantee you, along with the other things we've discussed earlier today about how you put together your portfolio, how you keep your mind like water, you will start elevating your success almost immediately. And so always ask yourself about new information. Be curious. And I can tell you something, one of the biggest things that's hit me in years was I listened to something, I guess it was a few months ago, Peter Grosskopf, Sprott. Okay, he doesn't do very many interviews. I've only heard him do 2 or 3. And he made a comment. He said, when he was talking, he said, there are 2 things that I have found that set people apart that do very well in this industry in making money from everybody else. There are 2 things. The first thing was they buy when others sell, and they sell when others buy. That was unremarkable. We all know that, and we all struggle with that. I don't care who you are, you have to master that. But then he said something absolutely, to me, that was just as important, if not more massively so. He said, also, they understand that 20% of their positions are going to give them 80% of the profits, and that the other 80% of what they hold will more or less subtract from that. And I got to thinking about that. And of course, it's the Pareto principle. It applies to all sorts of things in life, that 20% of your effort will give you 80% of the results on a particular task. So I got to thinking about that, and I approach it maybe a little differently than someone listening to this would do it. I went over and I looked, I had about 30 stocks. And I thought, now which ones do I think are the Pareto stocks? Like Peter said, that will probably give me, or that have the potential to give me that 80% return. I identified 6. And I had another one, which is an underperformer, which someday I think will really go well, but it sure isn't performing well now. But that was 20% of what I had. Now, I didn't just stop there. Once I realized that, I asked myself, these are the ones that I have a high level of confidence in. It doesn't mean I'm going to be right, but it means I've done enough research. There's a good chance I'll be right, that these will be my best. And they have already outperformed everything else I had. Those 6 already right now have shown me more profit than almost anything else I had in my account. And so I asked myself, do I have enough? Now, a lot of people would say, if you have 5% in all those stocks, then they're going to outperform, and that's just fine. But I want more beta. I went back in, and there were 2 or 3 of them that I didn't have as much as I wanted to really overweight it, to really make it a big deal if I was right, but yet not, turn my portfolio upside down. I bought more of the stocks. I brought it up to where I thought was an overweight level, but yet one that was, a certain margin of safety. Within weeks, I was up 20 to 40% on that addition of that position. And it was already proving to me that, at least at this point, I'm right so far about the ones that I think have more potential than most of the other things that I have. And in addition, I've stopped buying whatever I see out there that's new, that's exciting, because I ask myself, do I think this has the potential to be a really big deal? And if not, do I want to own it? Now, I can make a mistake. I can think it has no potential, and it turns out to be a monster. But if I ask myself that on each stock, I will skip buying 2/3 of the junk that I would get stuck with, even with a small amount of money. And I have more money to focus on the winners. So that, to me, was a huge, huge deal. Something that was so obvious that I couldn't see it until I heard Peter say it.
Very interesting, David. And hopefully we can all do enough research and diligence to pick the same kind of winners like that. But something else I wanted to touch on with you is the technological side of the research that you're doing and something you're helping out with. So tell us a little bit more about the Load Cryptographic Silver Project.
Well, it's a fascinating project. It's been going on for almost 4 years now. And it looks a lot different than when we started. David and I were kind of almost there at the creation, and we were early investors in it, by put in physical silver. We had to turn in physical silver and for load tokens, which is kind of creates a silver mass for the evolution of the project. And then now we have the AGX coins, which can be spent or saved. And each of these are backed by a gram of silver, and they're vaulted in 7 or 8 different warehouses around the world, very secure warehouses. And it's also evolved into something much greater than the sum of the parts. They spent a lot of time and money on regulation compliance first, rather than getting an idea out there and then finding that nobody would allow them to do it. And that the 75, or there may be 100 by now, different projects where people are attempting to do something like this on the blockchain, but we're kind of unique. In fact, I would say, and there's never any guarantee on anything, but I think the 2 projects, and we don't follow everything, but the ones that seem to me to have the best chance of success, I'm prejudiced about this, is the Load Cryptographic Silver project. It's actually an attempt to turn silver into money, not in your pocket, but in a digital way so that you can buy it and sell it. And then they got have Visa card, credit card, debit card, that type of a thing, and being able to store it on the blockchain. And you have that physical silver there that you can redeem if you want. And the other one that we profiled, and I think is a tremendous product, but it does something different than we're trying to do, is the Sprott Vault Chain Gold and Vault Chain Silver. And I think that project, still in its early days of understanding and acceptance by users, I think has enormous potential, and it will do some things very different than what we're trying to do. And so by going with the regulatory compliance, because they have a lot of that that's taken place in Europe, and there's some very important things taking place in the U.S. now, this has the potential to become a really big project, a successful one. And yes, it costs more to get in now than it did before. People want to do their due diligence. But if they go to road.one, there's a Q&A there that they can follow. And, we're not compensated for any of this, but we are participants in it. But this digital thing, this is kind of like gold and silver for the 21st century. And by the way, and I've done this in my writings too, I don't regard Bitcoin and gold as mortal enemies, and I don't think one's going to win out over the other. I think they're companions on the road to monetary freedom and to ability to have some privacy in your life and flexibility, and through the empowerment of the blockchain. And people hear about Bitcoin being stolen all the time. Bitcoin itself has never been hacked. But what happens is people have their Bitcoin on a public exchange, and it gets hacked. Somebody gets in and gets their account number, or they make a mistake when they're sending it. It's still fairly complex. Or they can set up a ghost account that really isn't theirs. Or sometimes the exchange people are crooks. And there's a big thing going on right now. I won't mention the name, but one of the big exchanges out there, which arrested a couple of days ago. So there's a lot of that needs to get weeded out. But the road project is a very fascinating one. There's never a 100% guarantee they're going to be successful, but it really has the potential. And it's doing something that David Morgan and I have wanted to see all of our lives, along with Hugo Salinas Price, who really is kind of the grandfather, the doyen of trying to bring silver back as money to the people. And his focus was on having the silver libertad in your hand. And it was a 1 ounce coin that would never decline in value. And, here's Mexico, the world's largest producer of silver. Can you imagine how that would empower the Mexican people to have that coin in their hand as money that couldn't be inflated away? Or in Argentina, where they have 50% inflation this year, or in Venezuela, where they have thousands of percent inflation. It's just funny. But getting gold and silver back, it's never going to be put back in our pockets literally like it used to be. But with the digital, enabled by the blockchain, some formulation, whether it's Lode or somebody else and somebody else, it's going to come back into the monetary system. And it's really helped what you and I are talking about with the miners and physical gold and silver, because it has instituted a conversation among people that never paid attention before. Before, it was just a bunch of older folks, 50, 60, 70 years old, who held gold and silver for 40 years. Now the millennials are coming in, and they're coming in through platforms like Robinhood, and they're buying mining stocks. And I think that's going to be another tailwind when the millennials, some of which are like the rest of us, they're in price chasers, but a lot of them are thoughtful, and they're going to come in and they're going to become a defining, powerful force in moving this forward in a way that is pretty amazing. And same thing like with what Jay Martin's doing over at Cambridge House. He's doing a wonderful, massive job of interviewing these people, just like you are, to get the message out and to get people to think and listen to what they have to say and apply some of their ideas that make sense to them. So it's all to the good, and that mix is going to come together in unpredictable ways, but it's going to be powerful, and it's going to be almost bigger than you and I can see right now.
Some very interesting food for thought there, David. As we wrap up here, is there anything else you'd like to talk about?
I don't know for sure, but I think people just, if they focus on getting their plan going and figuring out how to make it work, and don't be swayed too much by the tides that go back and forth. It's really easy to say, silver and gold are topping right now, but I'll buy more at a certain price. And I remember people saying this for years. And I remember some people that said when silver was $17 or $18 this spring, they said, if it gets to 12, I'm going to buy it. You saw this on chat rooms all over the place. Well, it got to 12 a few months later for a little bit. And when it got to 12, guess what? The premiums were $8 to $10 higher. So your $12 silver would have cost you $20 to $22 if you could find it. The paper price and the real price are totally different when you have these big swings. So don't be penny wise and pound foolish. And I feel like this, like if I want an organic hamburger, a hormone-free burger, if I can't afford 2 pounds of hormone-free beef, but I know that that's what I want. I don't want to just buy the regular stuff that's got antibiotics and all that. I'll buy a pound of it. If you can't afford 2 tubes of Canadian silver maple leafs or a tube of South African Krugerrand silvers, buy one. If you can't afford a tube, buy 5 or 6. But don't worry about the absolute price. Just over time, get what you want and what you can afford, and don't worry too much about the premium. And don't try to wait until some magical price happens, because when it does on the paper, the chances are very good it will not correlate in any way with the physical. And I remember in 2008 when this happened, silver went down to $9.50. You couldn't find it for anywhere less than $15. The same thing with platinum. It was $150 higher to buy it than what it said on the paper price. So keep that in mind.
Perfect, David. Is there anywhere that you can point for people to find more of your work? You're kind of a hard guy to really pin down. I know you write for the Morgan Report. Anywhere else you'd like to share with us?
I write almost every month something for the Morgan Report. I write a monthly column. I've done it for almost 7 years on Money Metals Exchange, MMX. And, I have at least one essay a month over there. I write probably half a dozen times a year by invitation for the Prospector News. And I'm always willing, if somebody finds an article that they'd like, I can send them a free PDF of it. Generally, they're very gracious people. They break out my articles for me. I usually it comes out as a double-sided PDF, and then I dispense them to kind of get my word out and their word out a little bit. So I do that, and I do a certain amount of ghostwriting, but then I write other articles, for people. But those are probably the 3 main venues that I think I'm most easily found on, and I've been interviewed quite a bit lately on some of the other sites, and, so that's kind of where, but, and they can write at, support at themorganreport.com if they need to get a hold of me, or if they have a question about David Morgan's work. We work hand in glove on these things, and I've learned a lot from him, and I continue to learn a lot. And I think we're a good team together, and we're here to help you. So don't hesitate to write to that venue too, if you'd like.
Excellent, David. Thanks very much for your time and your perspective today.
I really appreciate it coming on your show, Tom, and I regard what you guys do and your platform as one of the best, and maybe the best. So thank you for having me on.
Well, thank you for those kind words. Thanks again, David. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?